Welcome to Accounting with Audra. This is episode 3 in our series on accounting basics. In this episode, we walk through more tips and strategies for recording journal entries. If you're new to accounting or have struggled to grasp just how to journalize a transaction, this video will provide you with a step-by-step process on how to look at a corporate event and appropriately record it in journal entry form. I don't believe there's just one way to learn accounting, and my hope is that within these first few short videos, you're presented at least one way in which the overall concept of debits and credits clicks for you. You may easily have created useful mnemonics to memorize how to debit and credit accounts after watching video 2, but still be struggling with how to actually create a journal entry. We will start by looking at a simple 4-step process that may be intuitive for some and revolutionary for others, and then we'll do some practice problems so you can try out various strategies and see what works for you. Step 1. Read the transaction event and identify the impacted accounts as a result of the event. Note that every event has at least 2 components, as this ensures we always balance. But as you move forward in your accounting courses, you will find that certain transactions may impact 3, 4, or even more accounts. The process here doesn't change. Step 2. Determine whether each account you identified in Step 1 impacts either the asset, liability, or equity component of the accounting equation. It is possible that your accounts could impact the same category. Step 3. Confirm whether the account is causing an increase or a decrease to the asset, liability, or equity category it resides in. Finally, Step 4. Journalize your accounts identified in Step 1 and select either debit or credit based on which category you put that account in Step 2, and based on whether or not you are increasing or decreasing that category using the various tools we discussed in video 2. Using the steps in this process will work 100% of the time. Let's use my second favorite strategy to help illustrate. My second favorite strategy works if the transaction impacts the cash account. Hopefully at this point in time, you feel confident in the fact that cash is an asset, and that if you increase an asset, you debit it, and if you decrease an asset, you credit it. Anytime a transaction involves cash, I tell students to determine the appropriate debit-credit label for the cash component of the transaction. Do that first. Since debits must always equal credits, you can feel confident that the other side of the transaction is debited or credited accurately, even if you forget the specific rule for that account. Let's walk through 4 cash examples using the 4-step process. After going through the steps, I'll pause to provide you with an opportunity to prepare the journal entry first, and then we can together confirm whether it is correct or not. In our first example, we have shareholder contributing $1 million of cash to company I in exchange for common stock in the company. So Step 1, what are our accounts? We know that we have cash as one account and common stock as the other account in the company. Step 2, figure out where those accounts sit in our accounting equation of assets equal liabilities plus equity. We know that cash is an asset and common stock is the equity section of the balance sheet. Step 3, figure out whether or not we are increasing or decreasing our accounts. The company is getting $1 million of cash, and then the company is issuing common stocks. They're recording common stocks. So we have increases in both accounts, which makes sense. We balance because we increase both the sides. So knowing this information and what you've learned in video 1 and 2, can you figure out what the journal entry would be to record this doing the cash side of the journal entry first? Hopefully what you've determined is that since cash is increasing, it's an asset, we do that with a debit of $1 million. The flip side of our equation is that we credit stock for $1 million. So even if you forgot how to increase equity based on other learning devices we spoke about, you would know that in order for our debits to equal our credits, the second half of the equation has to be a credit to balance out. Let's move to another example. In this example, Company I pays $6,200 for new inventory. Let's identify our accounts. We have $6,200 of cash and we have inventory. We know that if we look at our accounting equation once again, cash is an asset and inventory is an asset. The company is getting inventory, which means it's increasing its asset account, and the company is paying cash, so cash is going down by $6,200, so it's decreasing the asset account. Both are happening on the same side of the equation. Can you write the journal entry related to this transaction based on the information we've discussed? Remember, do the cash side of the transaction first. What you've come up with is that since we're reducing cash and asset, we would credit it by $6,200. The flip side is inventory, also an asset, would be increased by $6,200 with a debit. Let's go on to example 3. Hopefully you're getting more and more familiar with this. Company I receives $45,000 payment of interest on amounts previously loaned to the company, M. What are our various accounts that are in this? So first, we have $45,000 they're receiving, our cash account. The second component of this is interest. They're paying it as interest or receiving it as interest. The fact that a loan is discussed in this transaction is irrelevant. Nothing is happening with respect to the loan. It's interest that is moving with respect to how the company is increasing or decreasing its balances. Next, we have to figure out where this fits in our accounting equation. So we know that cash is an asset. Interest, whether it's being received or being paid, impacts the equity section of the financial statements. Again, based on this information, our cash is going to increase because the company is receiving the payment. And in order for us to balance, that means that the interest must increase equity, right? We always have to make sure that our left and our right side of our equation balances. So again, could you do the transaction based on this information? What you should have determined is that since cash went up by $45,000 and it's an asset, we increase assets with a debit. The flip side of the equation, the equity side, if you forgot that you increase equity with a credit, then you would at least know to balance, you would need to credit interest revenue for $45,000. Okay, last example. In this instance, we have company I pays off its note of $3.8 million with the bank. The accounts that we're looking at are $3.8 million of cash and a note. So those are the two accounts. The cash is going to be considered an asset. The note is a liability. It's something that we owe to the bank in time. Our cash account is going down because we're paying the bank, and our liability is going down. We're no longer going to owe the bank any more money. So again, we're decreasing asset side and we're decreasing the liability plus equity side, which means we're perfectly in balance. Knowing this and starting with the cash component, can you journalize this transaction? If I started with cash, I would credit cash for $3.8 million. And the flip side would be a debit to note payable. I decrease liabilities with a debit, but again, if you had forgotten that part of the accounting equation of debits and credits, do the cash side first, and you would know that the flip side, the reduction of a payable, would be a debit of $3.8 million. After going through these 4 examples and first 3 videos, hopefully you have found a strategy that helps you better understand how to debit and credit the components of an accounting equation. In my next video, we'll expand our accounting transaction base to include concepts like deferrals and accruals. As always, if you found this video useful, please subscribe to my channel for latest updates and published videos. And as always, I look forward to receiving comments on other accounting and tax concepts you would like to see made easy.